gross employment income of 155k per annum, owns a mixture of commercial and residential property with expected gross rents of 165. Mr. Blake's wife is self-employed with taxable profits of 20,000 per year.
Okay, so what are your thoughts in terms of the first two sentences or paragraphs?
Well, from what he's saying, that Mr. Blake is an additional rate taxpayer, so any tax that he may be paying on the any rental income is most likely to be at 45%. Also, it doesn't actually say anything about whether, maybe finding out later whether or not there's any joint ownership of any properties. But it's pointing out that Mr. Blake's wife is self-employed, taxable profits of about 20k, so she's basic rate.
Correct. What about the gross rents of 165 per annum?
Oh, is it? Right, yeah. So that's gross rents before any expenditure is potentially deducted to arrive at taxable rent.
Correct. Excellent. And also, rental income is by default since 2018 is calculated under the cash basis. However,
cash basis, yeah. Yep. Is it over 150k?
Exactly.
It's yeah.
Gross rents. So receipts exceed 150. Therefore, the accruals basis will apply for Mr. Blake. And as you say, a self-employed, his wife, anticipated profit is £20,000. So you can probably start thinking about things like trying to shift some income from Mr. Blake to his wife. That's what you can start thinking. Let's continue.
I'm just quickly making a note of that, because that'd be a good planning point to mention. So, following details relate to 4 properties in Mr. Blake's portfolio. So, starting with 39 Oak Lane, purchased on 15th of April 2020, so at the start of 2020-21 tax year, consists of a retail unit on the ground floor, a self-contained residential property on the first floor. Okay. The retail unit was occupied by a sandwich shop when Mr. Blake acquired the property. There's been no change of tenant. The income from the shop is £1,000 per month. The flat had been empty for several months prior to Mr. Blake's acquisition, and before advertising for a new tenant. He incurred expenditure of £2,500 on electrical work, decorating and replacing the shower.
Okay, so let's discuss what we've got so far. Yeah.
If it's well, that's quite interesting in that it consists of a retail unit on the ground floor and a self-contained residential property. So the retail unit would be treated like a commercial property on which he's receiving commercial rents, I would assume. And the £1,000 per month, well, that would be the rent that he would receive from the tenant who owns that retail unit. So I'm just quickly checking the question. If it says discuss the relevant tax issues, calculations are not required. Well, if it's £1,000 per month, then I would assume 12,000 gross for the year. It doesn't mention anything about any expenditure at this point, apart from on the flat. So I would say commercial rent for the retail unit. If the flat had been empty prior to acquisition, then I would assume that the expenditure of 2,500 would most likely be considered some kind of enhancement expenditure prior to acquisition. Although I'm trying to remember, there's a rule about, say, is it like 7 years or 7 years prior to it? Oh, no, I think that's to do with their business income. But I would assume that's most likely to be some kind of enhancement expenditure that would go towards the cost of the property capital gains tax.
Agreed. That is if the flat was not fit for purpose. So if those costs have been incurred to bring the flat to a state where it can be rented out, then it would be treated as capital expenditure. And anything otherwise would be just simply an allowable deduction against rental income. So yeah, so those are sort of things, as you say, the question states that we just need to discuss the relevant tax issues relating to the information provided in respect of the 4 properties calculation that requires 15 marks. So you discuss the fact that the 2,500 was prior to the new tenant taking up accommodation. If the 2,500 remedial work had to be incurred to make the flat, is it tenable, the word tenable?
Habitable?
Yeah, exactly, habitable, that's probably better. Then it's capital expenditure. Anything else would be allowable deduction for tax purposes. In terms of the income from the shop, you mentioned that we have a unit on the ground floor, which is non-residential, and residential property on the first floor. Does anything come to mind, or anything that you probably need to think about when you see that?
Well, the first thing that came to mind there was the potential different tax rates, say, on the sale of either of those properties. That if it were the retail unit, then it would be at the, just bearing in mind Mr. Blake's tax rate, that it's not basic rate. So for the retail unit, he'd probably be paying capital gains tax at 20% on the sale of that unit, but he would pay 28% on the 28% on the first floor flat.
Correct. In terms of the first floor flat, for capital gains tax purposes, what are the reporting requirements if you dispose of the residential property on the first floor?
Report within 30 days of the disposal of the property online on the return, the online return.
Correct. And payment? So reporting 30 days?
Within 30 days.
Exactly. Reporting and payment all due within 30 days. Technically, it's a payment on account because, as you know, things can change in the tax year. For example, today is the 6th of May. We don't know if we'll be making any future capital disposals in the same year, and we definitely don't know if we're going to make a loss, for example. So we're making a payment on a gain, but that may be covered by a loss. So that's why it's called a payment on account. And the self-assessment tax return, the capital gains tax pages, will sort of straighten everything out at the end of the tax year, where you have the final snapshot. And then this payment on account is deducted, and you get either a refund or any further tax due. Just a few questions on that, because it's new for Finance Act 2020. What happens if you have a gain on a residential property, but it's covered by the annual exemption?
Just thinking that, well, if it were covered by the annual exemption, then there would technically be no tax, no capital gains tax due. I know from when I've actually had this in practice, where say I have done a few of these residential CGT returns where the gain can be assumed to be covered by the annual exemption amount, that you can input the annual exemption there. Correct. So any estimate can take account, any calculation can take account of the annual exemption and deduct it, which also would be a good planning point, because the residential property is taxed at higher tax rates.
Exactly. So you mentioned that obviously no capital gains tax is due. Agreed. And what about reporting? And reporting within 30 days if it's covered by annual exemption?
If it's covered by the annual exemption,
the answer is
report it.
There's no need to report. There's no need to report because there's no gain. So there's a chargeable gain, but there is no taxable gain. Therefore, no need to report. Similar question: what happens if you have a gain? Let's just say £100,000, but it's covered by PPR. Do we need to report? Do we need? Obviously, we don't need to pay, but do we need to report?
No.
Agreed. So no need to report if there's nothing to pay. That's what you need to remember. I just have a feeling that this might come up just because it's quite new and quite popular as well. These new rules on the 30-day return. And do I have any other questions on the return? Obviously, interest runs from the date of the 30-day payment. We mentioned it's a payment on account. Mixed disposal. So let's just say that this property, Mr. Blake disposed of it, the whole property. Now we have a retail unit and the residential property. What you have to do is you have to apportion out the residential element and then report that on the 30 days. And then the retail unit, as you mentioned at the start, is disposed of on the self-assessment tax return. Good. Let's move on.
I'm glad I picked this question now because actually, as you say, that's a good point. They could well test on this new reporting of the gains. So yeah.
I just have a very strong feeling because it's quite popular in practice as well right now. So, and it will be for the future as well. It's just obviously residential property disposal is just common. So you never know. If you have any questions on that, let me know. I'm happy to answer. Yep.
Will do. Thanks. Yeah. Okay. So incurred expenditure 2,500. We covered that bit. That may count as potential enhancement expenditure, as we discussed, if property is demonstrated to not be fit for living in, fit for purpose. The first tenant moved into the flat on 1st of March 2021. Rent was agreed at £800 per month, and the tenant paid the first 3 months' rent on 1st of April 2021. Now, remembering that point, because as we've mentioned before, that because this is being calculated on the accruals basis, it's not even though the first 3 months rent has been paid, would it only be technically for if it's the 1st of March, 800 per month, so it would only be up to, say, the 5th of April, the end of the tax year. So would it be 1 month's worth of rent that will be taxed?
Correct.
2020-21, yeah.
Correct, exactly. So the rental accounts will be produced on the accruals basis, but what's taxable is whatever is between whatever relates to 2021 tax year. So that's March 2021.
Just highlighting that point in my memory jog is about saying, because I'm trying to remember how it's described, say, with the accruals basis and the account and the cash basis. The cash basis is where it's calculated based on what is paid, not on what is expected or due, unlike the accruals basis.
Exactly. Correct. Correct. So that's why under the cash basis, there's no such thing as bad debt or debtors and creditors. It's just as and when expenditure is when income is received and expenditure is actually incurred. For eligibility, are you okay with eligibility? They want 50,000, and you cease to be eligible when receipts exceed 300,000.
Yeah, I do recall that from when I was looking at it. Where the gross property income does not exceed 150,000. If it does exceed it, the accruals basis must be used. And an election can also be made to use the accruals basis by the first anniversary of 31st of January. Is that in the case where, say, the taxpayer volunteers to be taxed on the accruals basis?
Correct. Exactly. Yeah.
Yeah. Makes sense. So you finance the purchase of the property with an interest-only mortgage. The monthly mortgage payment is $835, and the initial mortgage arrangement fee is $1,500. Okay. purchase of this property, as in like the whole property.
Exactly. So we have a bit of not an issue, but the mortgage is on the whole property. The monthly mortgage payment is 835 and the arrangement fee 1,500. What are your thoughts?
Well, I'd have thought the mortgage arrangement fee was not allowable for income tax purposes, that it wouldn't be deductible, but it may be an expense that can be deducted on any disposal of the property. I'm not entirely sure.
I think that one's very subjective, to be honest. That one's very subjective. But my understanding is that the mortgage arrangement fee is allowable.
All right, okay.
It is allowable. So I see where you're coming from, because you think, but you have to also understand it's to do with the mortgage. So it's not to do with it's difficult to also class it as in a base cost, if that makes sense, because it's not directly related to the acquisition of the property. It's more to do with the acquisition of the mortgage, which is slightly different. So I would say both the 835 payments and the 1,500, they would need to be prorated between the residential and commercial element. And the 1,500, again, there's difference of opinion, to be honest, but I think generally the 1,500 would be split between the length of the mortgage. So if it was a 10-year mortgage, you can't take a full deduction of 1,500. You take 150 per annum if the mortgage term was 10 years. To be honest, that one is subjective. People have different opinions. Different tax advisors have different opinions. I've previously said that the 1,500 can be written off in full, but then I've sort of changed my view as well. So it is one of them situations. It's not crystal clear.
Just making a note of that about the mortgage arrangement fee, because who knows, something like that could easily turn up in another question. Yeah. As you say, one of those subjective sort of niche points that no one's entirely sure of, sort of thing.
Yeah.
So, Blossom House. Mr. Blake and his wife recently purchased Blossom House, a residential property, as tenants in common, with Mrs. Blake owning 70% and Mr. Blake 30%. The majority of the funds for this purchase came from money that Mrs. Blake inherited. The property will be rented for the first time from 1st of July 2021 on a 12-month tenancy. Mrs. Blake does not own any other rental properties. Okay, so that's interesting, because I feel something about tenants in common rings a bell. Because when it say tenants in common, normally I would assume, of course, that the rent between the jointly owned property is split 50-50. But I don't know if necessarily the fact that Mrs. Blake holds 70%, I don't know if on the face of it that necessarily changes that 50-50 split. I know in practice you have to do further stuff to ensure that that is the case. But
yeah, so you have two types, as you know, joint tenants and tenants in common. So here they've specifically mentioned tenants in common. So joint tenants would be equal rights to the property, and the property automatically goes to the other owners if one passes away.
Yeah.
And your ownership of the property cannot be passed on in a will. So basically it stays within the joint owners, so joint tenancy. Tenants in common, however, you can own different shares of the property, which we have here, 70 and 30. And it's the opposite. So the property does not automatically go to the other owners if you die, and pass on your share of the property in a will. So so that's the understanding behind joint tenancy and tenancy in common to begin with. Now, in terms of the situation here, we have a 70-30 split, Mrs. Blake owning 70 and Mr. Blake owning 30%. Have you heard of Form 17?
Yes, I have. A declaration of trust in a Form 17.
Exactly. You have you come across it in practice, or is it?
Yeah, I have a couple of times. Yeah.
Okay. So, do you work in the taxation department in your firm?
Yeah, I do. Is that I actually recently, well, I say recently, it was like last year during the last tax season that I was advising one of the partners regarding a pair of clients who did jointly own a property on which they were receiving rental income, and we thought it might be beneficial to suggest maybe in the future changing the split of their income so as to reduce their overall tax burden. So
Excellent.
yeah, I have come across it in practice. Yeah.
Excellent. It's very important. As you say, it's a good tax planning point. And so basically, what does Form 17 do then? Enlighten me, please.
What it's supposed to do is to make the official declaration of the split of the intended split of the income between the two owners of the property, so that they can declare the official share. They can declare an official share, an official split of the income between them on their tax returns for self-assessment.
So the key word you mentioned is the intended split of income. So you have capital ownership, which is 70-30, and if they submit a Form 17, they can split the income according to the 70-30 as well, which obviously in this case will be beneficial. Why? Mr. Blake is an additional rate taxpayer. With Form 17, you can also sort of you can go even more unequal in the sense that let's just say capital ownership is 50-50. You can even go 90-10. So Form 17 sort of allows you to play around with the percentages quite flexibly. And then Mrs. Blake will declare 70% of the income from Blossom House on her tax return, and Mr. Blake 30%. What are the administrative duties when it comes to Form 17? Any thoughts?
I'm not sure of any deadlines, although I assume it would have to be by a date following the end of the tax year in which the split is intended to change. Or I'm not sure I've come across any of the admin points in my files, but yeah.
The two basic points you can always take from Form 17 is it must be jointly signed between the owners and submitted within 60 days of signature. So jointly signed, submit to HMRC within 60 days of signature. And when will income be split? It will be split from the date the form was signed. I think the first property was just owned by Mr. Blake, right? Yeah. So here would be a good place where you mention your tax planning point. I think you did mention at the start where you said the property or any other properties for that instance can be transferred to Mrs. Blake. So please explain why.
But that if she doesn't own any other rental properties, but transferring some of the properties or at least some of the income or dividing the income on some of these properties such as Blossom House so that she received at least some of it would reduce the overall tax burden as she is the basic rate taxpayer, that more of that income would be taxed at basic rate of 20% and less of that income would be taxed on Mr. Blake at potentially at 45%.
Correct. And what will be the capital gains tax consequence of transferring ownership?
if the ownership were transferred, then would the gain be split between them according to their respective shares?
Think about it. I'm talking about the capital split, and we're talking about spouses. So basically, as in when it comes to properties,
connected persons.
No, we're talking nil gain, nil loss between spouses. Yeah. So any transfer of capital ownership. So basically, when we're talking about properties, we're talking about land registry. So you literally, I'm not too sure about the legalities, but you have to file with the land registry. But for tax purposes, that's a capital gains tax disposal. However, transfers between husband and wife are at nil gain, nil loss.
Yeah.
So you probably can get a half mark for that, or maybe even potentially.
It depends on how much they allocate to it, but yeah. So
Mrs. Blake does not own any other rental properties, as you say, so it would be beneficial to transfer some ownership to her, potentially. Obviously, there's the tax saving, but then obviously the real life element, which is, does he trust his wife? So obviously, I think sometimes when we do these questions, we always think in tax, but there's always the real life element that obviously exams, they don't teach you, but it's good to know. Because when it comes to practice, that's what you have to think about, those things as well.
Yeah. All very simple in principle, but yeah. So on 5 Ash Crescent, previously let this residential property rented $550 per month to a long-term tenant. Tenant left in June 2020. Mr. Blake's brother moved into the property, paying rent of £100 per month. In September 2020, Mr. Blake spent $3,500 decorating the property and replacing some damaged roof tiles. Mr. Blake's brother is expected to continue to occupy the property for the foreseeable future. Okay, that's quite an interesting one. I'm trying to think if it's of any significance that it's to his brother who's it's his brother who is the tenant. Because what I would say certainly first is that for the rent of $550 per month to the previous tenant, that Mr. Blake would be taxed at income. It would be subject to income tax for those first 3 months, or April, May, June, when the tenant left. But then with the rent for Mr. Blake's brother, I'd query if that's meant to be at a market rate. Is that correct?
Exactly. So, so whether it's to his brother or anyone for that matter, when it comes to rental income or just renting out a property, you have to, if you are offering the property at below market rent, then your expenses are also restricted to that sort of percentage. So here is 100 out of 550. So the 3,500 would definitely be restricted. And for example, if parents buy, let's just say parents have a son who is going to university. So they decide to buy a property near the university. Son stays in the property rent-free. Can the parents claim any allowable expenditure, as in, for example, repairs, decoration, and things like that? The answer is no.
No, yeah.
Because they're not receiving any rent at all. If they're receiving half of market value, for example, they can claim half of the expenses, and so on and so forth. So that's the key point here. Other than that, you'd mentioned the 550 would be taxable as normal, and then the £100 is still taxable, but the 3,500 would definitely be restricted to a just and reasonable percentage. And then the excess would not receive any tax relief.
Okay.
Yep.
Building on what you explained there, that say in September 2020, 3,500 decorating the property, that depending on what the market rate of the rent is, if it's less than market value or less than the market rent that's being charged to the brother, then Mr. Blake would only be able to claim a proportion of those expenses for decorating and repairing the roof. So,
exactly. Good stuff.
That makes sense. I need to find that somewhere because I couldn't really see it in my memory joggers, but I did recall it vaguely, the idea that if it's at less than what would be the anticipated market rent, that there would be, or basically that there's a catch to it.
Exactly. I think points like that you might end up finding it in the study manual, because it's just a tiny point. But yeah, if it's not in the memory joggers, then you'd probably find it in the study manual.
I can jot it down. I'll see if I can find something later. I'm pretty sure I read something somewhere. But yeah. So the ceramics factory acquired this factory in August 2017 and lets it for $3,500 per month. He borrowed £100,000 to finance the purchase and pays interest of $175 per month. The loan is secured on the house where he and Mrs. Blake live. He has never included a deduction for any of the interest paid when preparing his tax returns. Okay, that's interesting because the factory would be a commercial property. I mean, it doesn't explain what he lets it for, but I would assume that it's for a commercial on a commercial basis, and it's commercial property, and that any interest paid on the loan would be fully deductible in this instance.
Exactly. So it doesn't matter that he's borrowed the 100,000 and he has secured it on his residential personal property. It doesn't matter. As long as the borrowing has been fully used for the factory purposes, the full interest will be an allowable deduction on his tax return. So he has never included a deduction for any of the interest paid when preparing his tax returns. So to begin with, for the 2021 tax year, he'll just start deducting it. That's the advice. So you start deducting. For the what would we do for the 1920 tax return?
Well, any returns before the 1920 tax return can't be amended, but he could amend his 1920 tax return to include the appropriate deduction within 12 months of the submission or the submission deadline, which we would assume to be 31st of January 2000. If it's 1920, it would be 31st of January 2021. So the deadline for amendment would be by 31st of January 2022. Excellent.
And then the balance of the years, so acquired in August 2017. So we're looking at the 17, 18, 18, 19 tax year. What would we need to do instead?
For the 17, 18, and 18, 19? That's a good question, because if you can't officially amend those tax returns, then I don't know, he wouldn't be able to claim any deduction via those tax returns, or the deadline for amendment has passed. So
agreed. So the deadline for amendments are passed. So therefore, have you heard of overpayment relief claims? Where you can go back 4 years.
I have not heard of that, actually. I don't think.
Okay, that's interesting. It's probably in one of those chapters where there's a lot of reading and theory behind it. But it'll probably come with inquiries, discovery assessments, and then overpayment relief claims.
Okay. I'm just having a quick look to see if I can find.
Yep.
Hang on. Overpayment relief claims. I don't think I've ever heard that in practice either, so that's interesting.
I think once you realize it, you'll start hearing it a lot more. It's just one of them things where, so basically, it's a claim made in writing and it's for the repayment of tax which they believe they should not have paid or should not be due. So, as you say, existing self-assessments are left unchanged. If you're not out of time for amendments, you make the amendment. But anything else, you can claim overpayment relief, and it's a claim, and it must be made by the person who is due the relief. So that's the first thing. So it's effectively a claim to HMRC for repayment of the amount of tax which they believe they should not have paid. Okay, that's the first point.
I found it. It's in one of the self-assessment chapters
Exactly.
on recovery of overpaid tax. Doesn't really say anything in the memory joggers, but yeah, there's a small piece at the end there that I'll have a read through today. And
is it on overpayment relief claim specifically, or is it?
What it mentions is that where the 12-month deadline for a taxpayer to amend a return has passed, a claim can be made in certain circumstances to recover tax overpaid as a result of a mistake. The claim must be made, again, tying in with what you said, within 4 years of the end of the relevant tax year. So if the taxpayer has made a mistake for, say, 2021, a claim must be made by 5th of April 2025. So if it were 1718, so if it's to the end, 5th of April 2018, then he could potentially, Mr. Blake could potentially do a claim then by 5th of April 2022.
Agreed. Excellent. So that is exactly what this was testing, and that will probably definitely give you 1 mark. If not, I think that point will give you 1 mark. So 17, 18, 18, 19 tax returns out of time for amendments, therefore go via the overpayment relief claim, and he currently not out of time. He has up until 5th of April 2022. That's definitely 1 mark. And another mark for the amendment of the 1920 tax return and current tax return. You just treat it as fully allowable. It does not matter that the loan has been secured on his personal home, as long as the finance or the loan has been fully used for that factory. I think it's a good question. 15 marks. Discuss the relevant tax issues related to the information provided for properties. I think it's a good question. It's nicely broken down, 4 different, completely different scenarios. So therefore, you can pick up the early marks easier within each 4 properties. Do we have any questions?
Seems fairly straightforward. Well, so I say fairly straightforward, as in it seems
fairly
clear.
It's self-explanatory.
Yeah. So feel encouraged that I've picked up quite a few of the key points there. It's really that last bit on the recovery of overpaid tax that I wasn't really aware of. So I'll add a couple of notes on that.
So in terms of the, it's important to be, with these advanced technical papers, it's important to be proactive. So whether they tell you to be proactive or not, you have to be proactive in your tax advice. So things like the transfer between the spouses of properties to ensure that more rents are taxed at basic rate compared to additional rate, that would have been proactive tax advice. Nowhere has it mentioned that they want to know how they can mitigate the tax liabilities, but you've been proactive and you mentioned. And then obviously you think outside the box, you can get a mark for the capital gains tax implication, which is nil gain, nil loss. So keep that one in mind. In terms of the first bit of the question, I think most of the marks would come from there. You'd say the expenditure prior to letting, that's an important part. It is disallowable if the work is required to bring the property into a habitable state. So you do definitely get a mark there. And the part about the brother, you'd be picking up marks for the disallowance of excess expenditure. Good.